When people start investing, they often feel overwhelmed with new terms and financial products. The learning curve is steep. There's a lot of jargon to learn and technical knowledge to be mastered before we understand how to invest our money wisely. Fortunately, here at Bull Academy, we specialize in creating videos to help you speed up the pace of your understanding. We want to help you acquire the knowledge you need to make sound decisions. 3 financial products that often confuse people at first are indexes, mutual funds, and ETFs. Some of your friends might swear by ETFs, and you know that mutual funds are classic financial products that have stood the test of time. Meanwhile, Warren Buffett, one of the wealthiest people in the world, swears by indexes for the average person. But what are these mysterious financial products, and what are the differences between them? We're going to go through them one by one and explain everything you need to know. Mutual funds. Mutual funds have been around since the 1920s. They were invented by a group of American economists who wanted to diversify investors' portfolios. Today, there are tens of thousands of mutual funds with trillions invested globally. Mutual funds are typically managed by professionals who invest on behalf of their clients. Fund managers charge fees for the management of these funds. It's the price you pay for someone else's knowledge. In a mutual fund, each investor pools their money with other investors to buy shares in various securities, like stocks and bonds. Fund managers invest in an array of different securities to diversify the fund's risk. They also pick when to buy and sell securities, attempting to time the market right to maximize returns. This is called a managed fund. Compared to investing in a few of your favorite stocks, the risk is theoretically reduced because when one company performs poorly, it could be offset by another company performing well. It's like health insurance. When people buy health insurance, a certain amount of people will pay every month and not need care. Their money will go to pay for the care of the sick people who do need care. The income from the healthy group covers the expenses of the sick group. Typically, there's a minimum investment required to buy mutual funds. You don't have to spend hours researching with mutual funds because professionals do all that work for you. You just invest your money, and the fund managers do the rest. However, they can't be bought and sold like stocks, so you can't buy into mutual funds on Robinhood. In order to invest in mutual funds, you'll need a legacy investment account, like Charles Schwab or Fidelity Mutual.
ETFs. ETF stands for Exchange Traded Fund. An ETF is an investment in securities that track the performance of a particular index, commodity, or basket of stocks. These funds are designed to be flexible. Because ETFs track their underlying index or asset, rather than being managed by humans, if something goes wrong with that asset, it will be reflected in the value of the ETF. These funds are passively managed and traded on exchanges like individual equities, which means you can buy them on retail investment apps like Robinhood. Generally, ETFs have historically performed better than mutual funds as they return more to investors each year. This is due in large part to the simple fact that they have fewer fees associated with them. Aside from yielding greater returns on investor capital, the benefits of ETFs include, but are not limited to the following. An ETF can be traded like a stock, making it easy to buy and sell them. Accordingly, ETFs can be traded anytime during the day, so long as the market is open. This is unlike mutual funds, which only trade outside of active market hours. Next, if you prefer a less risky investment strategy, ETFs provide more diversification than buying individual stocks or bonds. Finally, ETFs have less red tape and documentation, like the need for special accounts. Still, ETFs aren't without their drawbacks. For one, mutual funds don't involve transaction fees, but many ETFs do. Additionally, some ETFs may have high tracking errors, which indicate a notable difference between the returns generated by the fund and those generated by the index it tracks. Beware of these ETFs. These are only some of the trade-offs to consider when searching for the right type of fund for your investment plan.
Indexes. Indexing is a strategy for investing in stocks and bonds that seeks to match the market's return as a whole. Indexes themselves aren't financial products you put your money into. They're a way of tracking specific market segments, like renewable energy or infrastructure or bonds. Indexes are a measurement, a guide, that provides information about the economy. Index funds are funds built around those measurements, either mutual funds or ETFs. Index funds invest in all or many of the securities in a certain index. Examples include Standard & Poor's 500 Stock Index and the Vanguard S&P 500 ETF that tracks it. Guggenheim Solar ETF, TAN, is an index fund that invests in renewable energy companies. This saves investors the footwork of having to dig through all of the energy companies on the list. Instead, investors can simply invest in the ETF, which is passively managed by professional fund managers. When it comes to performance, think of indexes like this. One of Einstein's most famous theories was relativity. But if everything is relative, how can anything be measured? What do you measure things against? For Einstein, the speed of light was the benchmark against which everything else in the universe was measured. The speed of light in Einstein's theory and indexes both measure things in a constant state of flux. How well one stock in a segment of the economy is performing is relative to how well other stocks in that same segment are performing. When we think about how well First Solar is performing, for example, one of the first questions that should come to mind is, compared to what? When we compare First Solar with other renewable energy stocks, we have a frame of reference to see how well it's truly performing. If a social media stock is up 3% for the month, but the others in the sector are up over 10%, that 3% isn't great. The index of a sector's stocks enables these comparisons within the sector, but also between sectors. Additionally, if a fund tracks an index, it gives the fund a way to manage their risk against any given percentage of that sector's companies underperforming on any given day, week, month, or year. Indexes are available for various sectors of the economy, ranging from small-cap stocks to treasury bonds. Indexes have historically outperformed the average individual stock, especially when diversified across different sectors of the economy. Because it's difficult to reliably time the market, index funds often beat the performance of actively managed funds, such as traditional mutual funds, over a long period. This is why Warren Buffett believes that slow and steady investments into funds based on indexes are the best approach for average investors, those who don't have the time nor skill to actively manage their own portfolio of individual stocks. All three of these tools are geared toward long-term investing rather than short-term gains. Because these products are either managed or track sectors of the economy, they're dynamic and constantly changing. This makes them much more reliable over the long term than purchasing individual stocks. It also means you'll have to do a lot less homework as an investor, as you'll only need to research individual mutual funds and ETFs rather than all of the individual stocks they contain. Of course, it would be a good idea to inspect the quality of the companies within a fund to ensure the fund is worth your time. The opportunity cost of investing in a bad fund, be it passively or actively managed, can be steep if you're not careful in your selection. The good news is, nothing is permanent. If you need to exit a fund, you can do so in a reasonable amount of time, before you lose more than you can manage.